World markets quake over risks to U.S. economy. Significant turbulence is being experienced by global markets as concerns about the stability of the U.S. economy grow. Investors are growing more concerned that a recession could be sparked by the Federal Reserve's continued high interest rates in the wake of a dismal jobs report. Major stock indices have dropped sharply as a result, with notable declines in Europe, South Korea, Japan, and other markets as market players brace for possible economic consequences. We will go into great detail about it in this video. Number 7. Significant market declines. On August 5, 2024, Japan's Nikkei 225 index, a measure of investor sentiment and the nation's economic health, took a devastating 12.4% hit, its worst one-day performance since the infamous Black Monday crash of October 1987. This historic sell-off was the culmination of weeks' worth of simmering concerns about the U.S. economic outlook rather than an isolated incident. The impetus came from a dismal U.S. employment report that showed a sharp slowdown in job growth that was much slower than expected by analysts. Investors in Japan responded quickly to this news, fearing that a potential U.S. recession could have significant ramifications for the global economy. At the time, investors were already coping with the prospect of rising interest rates and inflationary pressures. The previous Friday's nearly 6% drop in the Nikkei caused traders to rush to liquidate positions and reduce their exposure to risky assets, which intensified the sell-off. The fragility of investor confidence and the speed at which market sentiment can change in response to economic signals from the world's largest economy, the United States, are highlighted by this synchronized decline that occurred over the course of 2 trading sessions. The sharp reminder of how intertwined the world's financial markets are and how prudently policymakers must handle economic challenges is provided by the size of the Nikkei's decline. Number 6. Widespread Asian market losses. Other significant Asian indices followed suit as the shockwaves from the Nikkei's historic decline reverberated through international markets, illustrating the investor sentiment contagion effect. Taiwan's Taiex index, which measures the performance of the island's stock market, fell close to 10%, while South Korea's Kospi index, a crucial indicator of the nation's economic performance, crashed by more than 9%. Due to Asia's substantial reliance on trade with the United States, concerns that a slowdown in the American economy would have a major effect on exports and economic growth were the main cause of these declines. The possibility of decreased demand for their products and services caused investors in South Korea and Taiwan to react, which resulted in a widespread sell-off in a number of industries, including consumer discretionary, manufacturing, and technology. These markets have experienced a sharp decline, which emphasizes the interdependence of global supply chains and the susceptibility of export-dependent economies to shocks from without. Given that the U.S. economy is the main market for a large number of Asian exports, investors are preparing for a possible knock-on effect that might impede regional economic growth and corporate profits. The coordinated losses in Taiwan and South Korea highlight the necessity for governments to diversify their economies and lessen their dependency on a single trading partner. They also highlight the significance of sustaining robust domestic demand in order to mitigate the effects of external shocks. Number 5. European markets follow suit. European stock exchanges opened lower as the turmoil in Asian markets spread around the world, reflecting the general fear among investors. A major gauge of the state of the Eurozone's economy, Germany's Taiex index dropped 2.3% as investors responded negatively to the U.S. employment data. This drop was a sign of larger worries about the possibility of a global economic slowdown, which may have an effect on exports and growth in Europe. Because the economies of the United States and Europe are intertwined, any indication of weakness in the latter could cause investor confidence to decline on the other side of the Atlantic. Furthermore, European markets are especially vulnerable to outside shocks because they are already dealing with their own set of economic difficulties, such as rising inflation, problems with the energy supply, and the COVID-19 pandemic's aftereffects. The coordinated drops in major European indices, like the UK's FTSE 100 and France's CAC 40, show how fragile market confidence is in a world growing more interconnected by the day. Investors fear that a downturn in the U.S. economy might have a cascading effect, lowering demand for goods and services in Europe and possibly igniting a recession within the Eurozone. The initial losses experienced by European markets highlight the necessity for policymakers to keep a close eye on the situation and take appropriate action to promote economic growth and preserve investor confidence. Number 4. U.S. Futures Plummet. Pre-market trading saw a sharp and dramatic decline in U.S. stock futures, with Nasdaq futures falling 4.7% and S&P 500 futures falling 3.1%. This sharp decline suggested that investors were expecting big losses in major indices when the cash markets opened, signaling that they were ready for a difficult trading session. Given the increased risk aversion among investors in the tech sector, the tech-heavy Nasdaq futures took a particularly severe beating. Significant pre-market losses were seen in the stocks of well-known tech firms like Apple and Nvidia as investors tried to lessen their exposure to growth-oriented stocks, which are often more susceptible to changes in the economy. This decline in futures trading is indicative of a general fear and uncertainty among investors who are worried about the consequences of a slowing economy and the possibility of additional Federal Reserve interest rate hikes. The futures market is a good indicator of investor expectations because of its sharp declines, which suggests that many people are beginning to believe that the economy is failing and that they should reduce their exposure to risk. In anticipation of the opening bell, traders and investors are keeping a careful eye out for any indications of stabilization or additional declines that might set off a wave of panic selling and worsen the market chaos. Number 3. Disappointing employment data. A disappointing U.S. employment report that showed a marked slowdown in job creation that was much worse than analysts had predicted served as the impetus for the recent market turbulence. According to the report, non-farm payrolls grew by just 75,000 in June, significantly less than the 150,000 consensus estimate. The unexpected slowdown in hiring sparked grave worries about the state of the U.S. labor market, which had previously supported the country's economy. Because employment trends are a major predictor of the state of the economy as a whole, consumer spending potential, and overall growth, investors are especially attentive to employment data. There are concerns that the unexpected slowdown in job growth may cause consumer confidence to decline, which would further hurt corporate earnings and economic growth. Economists and market analysts have been debating whether a recession is likely to occur and whether the Federal Reserve should modify its monetary policy in reaction to shifting economic conditions as a result of this scenario. If the labor market keeps getting worse, pressure may mount on the central bank, which had been unwavering in its resolve to raise interest rates in order to fight inflation. Investor confidence has been eroded by the dismal employment data, which has also sparked concerns about how resilient the U.S. economy is to both internal and international difficulties. Number 2. Increased market volatility. The sharp increase in the Volatility Index, or VX, was indicative of the increased level of anxiety and uncertainty in the markets. The VX, sometimes called the Fear Index, gauges the S&P 500 index its anticipated volatility for the ensuing 30 days. An increase in the VX of more than 100% suggests that investors are pricing in large swings in stock prices, which can result in higher trading expenses and broader bid-ask spreads. It may be difficult for traders and investors to execute deals at advantageous prices in such a volatile environment. The VX spike is frequently linked to times when the market is distressed, and its sudden increase implies that many investors are looking to buy put options or other protective instruments as a way to insure against future losses. This increased volatility may also set off a self-reinforcing cycle in which a rise in fear drives more selling, which lowers prices and heightens uncertainty. Because of this, market players are probably going to take more cautious approaches, emphasizing capital preservation and risk management until the economic outlook improves. The high VX readings highlight the importance of a diversified portfolio, a disciplined approach to investing, and readiness for probable volatility spikes in the coming months for investors. Number 1. Cryptocurrency decline. The world's largest digital currency by market capitalization, Bitcoin, saw a sharp decline of 14% as a result of the turmoil in traditional financial markets, which also affected the cryptocurrency space. Due to the fact that investors frequently turn to digital currencies in times of market stress in search of higher returns or as a hedge against economic instability, this decline emphasizes the growing correlation between cryptocurrencies and traditional assets. But given the current extreme volatility, Bitcoin's incapacity to hold onto its value begs concerns about both its short-term suitability as a safe haven and its long-term viability as an alternative investment class. The drop in cryptocurrency values is a reflection of investors' general aversion to risk, as they place a higher value on stability and liquidity than on speculative ventures. A revaluation of cryptocurrencies' prospects for widespread adoption has resulted from the downward pressure on them caused by market sentiment and regulatory worries. The cryptocurrency industry has a difficult time positioning itself as a dependable asset in the face of economic volatility, while the market struggles with uncertainty. The increasing correlation between Bitcoin and other high-risk assets, like growth-oriented equities and tech stocks, emphasizes the necessity for investors to thoroughly weigh the potential benefits and risks of investing in digital currencies. These points highlight the interconnectedness of global markets and the significant impact of U.S. economic indicators on investor sentiment worldwide. Thanks for watching our video, and don't forget to subscribe to our YouTube channel.